Back with first trades, and let's shift the focus to Shriram Finance. Ever since we've heard about MUFG buying a 20% stake in that stock, the stock has done very well for itself, and that high continues. So in an exclusive chat with ET Now, Shriram Finance's Executive Vice Chair Umesh Revankar broke down the rationale behind the MUFG deal, and he also explained their growth roadmap, and he said that they expect return ratios to improve and borrowing costs to come down. Listen in.
When we were looking at raising our equity further, we were at around 20%. And since we have an international rating, in fact, we have a rating from Japan rating agency also, BBB+. There, the requirement is that you should be around 20, about 20. Because the rating, the way they look at banking rating and non-banking rating, there's a difference.
Right.
So we were definitely wanting to be about 20 at any point of time. So we were looking to raise some equity. We had two options. One, to go through a QIP process and raise for a short-term capital. Every 3-4 years, then you go to the market, so that your stock will get re-rated, you may get better premium and all. That's one way to look at it. Okay. Second way, try to look for a partner who have a very good international track record and experience in investing into different countries, wherein that you can take something out of them to build the business or rebuild the business in India. So, as we were talking to many institutions, I found MUFG is one of the top brand or top bank in the world, 10th largest in the world. And they also have experience of investing in US with Morgan Stanley with 23% and in Asian countries with Philippines, Thailand, Vietnam and Indonesia. And they were also looking at investing in India, because India is now a fastest growing large economy. And since they had already showing some interest in India, they were betting on India.
Right.
And we felt that this is the right opportunity to collaborate or meet them and discuss with them. As we were discussing, they were wanting to be a larger partner. When I say larger partner, they wanted to invest at least 20%, so that they want to be a large partner to the running of an operation. So as we discussed, we felt that we have a similar culture in the organization.
Right.
The philosophies are almost common, and they're highly professional. And we also are quite professional in the way we have been doing our business. A lot of similarities, and we felt that we should proceed. And then after that, there were other discussion on what we can get out of them and how they can help us. And we found that their digital play and all, they're quite strong, and that's the one way to take something out of them.
Right.
And then the deal came to some kind of understanding, and we closed. See, here, please understand, even though our promoter holding come down from 25.3 to 20.3, when you have a very strong partner with the 20%, it gives you some kind of a comfort to the lenders. Ultimately, we have to impress the lenders. We have to impress the credit rating agencies. That serves the purpose.
That makes a lot of sense. Let me ask you, this 20% stake, you hinted as part of your answer that they wanted a larger stake. Is this final at 20, or is there scope for an increase?
As of now, our discussion is only for 20.
Okay.
We have not discussed anything about that. Even they have not really talked about going beyond 20. Because if you look at their other experience in India, they were also looking at around 20 only, because you would have seen from the media that there were some talks of MUFG with other institutions. It was also around the same.
Okay. And does this at all change in terms of control or ownership? Is there anything built around that or a thought process around that has been discussed or spoken about?
See, they have been giving example of their own investment in the various countries.
Correct.
They have told us that they want the current management to continue. They're happy with the management. They have seen the depth in the management. They have interacted with our senior colleagues, and they're very confident. They have no intention to really, come and run the business or even participate in running the business.
So only 2 board seats. That's all they've asked for, and nothing more. Even the managing director CEO role continues with Mr. Sharma as is.
Yes, see, Mr. Sharma will definitely continue as is. There's no change in the leadership.
Okay, and you expect that stability to continue over the next 3, 4, 5 years? Is that the visibility? Because now you have enough capital, and therefore you have the visibility for 4, 5 years. And leadership is important when you're trying to grow, and you've said that you want to grow at 20%. A stable leadership will be important. You expect that stability in terms of leadership to continue?
I definitely expect same thing, because that is the kind of understanding we have. And not just 5 years, for a very long, we will have a very long journey together. I don't think nothing will change. And we are trying to build a common vision. We already have some vision built up to 2030. We would like to have a very long vision so that we go on that path without any much of frictions in between.
I'll just shift focus. There has been a non-compete fee which has been agreed as well. How should shareholders look at this? And what's the purpose or what's the rationale behind that?
It's basically, whenever there are business transactions, there is a non-compete clause. Maybe for 1 year, 2 years, you don't start anything of similar business. In this case, we said that we don't intend to start a similar business. They don't want another business to be started by the same promoter, because promoter is going to be part of the management and they're going to remain the promoter. So we are going to remain the promoter for long. There's no question of we starting something else.
And how should minority shareholders look at this? It should not perturb them.
It should not perturb them, is what I feel, because they have a very strong partner, and that gives them a comfort.
One of the other key contours of the transaction is the valuation at which MUFG has come in. It's at around 1.9 times book, and it's a sizable quantum that it brings to the table. I understand that there can be arguments on both sides, but what is your thought process or rationale in terms of the valuation that you've got at 1.9 times? Because certain pairs with a lower free float trade at a higher multiple. So I'm trying to get to how you think and how you look at the valuation.
See, the way market values each of the institutions or organization are different. We can't have any justification or comments on the same. But we are very clear with in our discussion, whatever is the SEBI formula should play. So at that, maybe we are discussing for nearly 6 months, we decided in advance that whatever is the market rate, and as per the SEBI formula, we'll fix the rate. Let us not talk about premium or something additional on that, because the investor also should feel comfortable that there's a fair play for them, because they're coming with a very large check.
You've guided now of a confidence of growing at 20% plus. How quickly does the 20% growth kick in? As early as H2 FY26 itself? While the capital hasn't come in, but you've already got the confidence that the capital is going to come in. So do you start growing right off the bat?
See, I think for this quarter, maybe next quarter, we would not be rushing, but we will be building the capabilities. We need to build the capabilities, even though we have a branch network, we have a management bandwidth, we have a people at the place, but we need to plan for a little higher growth, which we are already preparing ourselves, and that will start. Okay, I think that will take little time, maybe 6 months time, to start growing at higher rate, because we have been now talking to various OEMs to see how much more we can increase our new vehicle financing. We have been hitherto limiting to used vehicle with the purpose, because we felt that this is the one area where they don't get credit elsewhere. So it is better to be in that place. But many of our customers are upgrading and moving out. If I'm able to hold them, that itself will give me that additional 5%. I don't have to really go out of the way to bring in new customer to really grow 20%.
And you're not doing this today because of capital being there is a certain lack of capital. Can I call it that?
I don't think it's a capital issue. It is the borrowing cost issue.
Right.
My borrowing cost being at particular level, I cannot give comfort to my customer who is moving to the other institution for a lower cost of fund.
Right.
Today I can say, I can definitely say, because maybe around 10, 15, 20% of my customer will move. And by giving them that additional comfort, my net interest margins are not going to come down, because my cost of borrowing comes down, which I am passing on to them. That's all. So net interest margin will remain same or even increase.